Good evening, Options Trading Signals members. This is JW Jones coming at you with a little extra content this evening. Going to get up on my soapbox a little bit. I know this is going to get out a little bit late. I had some personal matters that I thought I'd at least share. Here recently, my wife was in a minor car accident, and she's perfectly fine. She wasn't even scratched, but we've been dealing with buying a new car and all of the rigmaroles that go with that. So I was involved in doing that this evening, so I apologize. I was running a little bit late, wasn't expecting all this stuff to be going on. But as promised, I'm going to deliver on my soapbox rant. But before I do that, I'm just going to talk a little bit about the S&P. We'll cover that in the morning. Obviously, with the overnight session right now, we're getting a little bit of profit taking, but it's pretty marginal. Basically, what we're watching for is this level right here, the 1290 recent highs. I think a lot of eyes are on that level. If we break, we're probably going to run to 1325, and then we'll take out. If we take this area out, then it won't be unlikely to see 1350 in the test of the 2011 highs if we break this level right down here around 1210, 1212. First we'd have to get down to around 1230. We break down below that, then we're going to hit the neckline and from in the 50 period, and from there things get ugly in a hurry. So we can go pretty sharply in either direction. I pointed out today that we're kind of in a point of no return in terms of the position of where we're at on the technicals. When we see all these diamond formations, which are very rare, forming all over the place, I could probably go through 30 different underlying stocks that have a diamond formation on their daily chart, and then on top of that we have a head and shoulders pattern, which is still intact at this point. I mean, a lot of people write it off because it's taken off, but many times you see this right shoulder really come up, try to shake people out, and then it rolls over and dies. That's always possible. And the other thing that we could see is we could see a test of the recent highs and a pullback, and we got what appears to be a double top on the daily chart. So, you know, I think we're in the process of trying to form some kind of top here. I don't see this breakout happening. Doesn't mean it can't, but at least right now I don't see it happening. And that's kind of where we're at on the S&P. Throw on the dollar index. And I just wanted to show members this real quick because I haven't shown it in the videos. As of today, and obviously we're getting a little more selling pressure this morning, the recent move from bottom to top over that period of time where we had the dollar surge, we've got a 0.382 retracement. So the dollar is hanging tough. I mean, it's sitting there just consolidating, biding its time. I still believe we're going to see this play out in the future. I think we're going to see the dollar rally at least for a period of time. I don't think it rolls over and dies here. And let's talk a little bit about that. Now it's time to get out the old soapbox and kind of explain a few reasons why I believe the market's getting close to a top. Some of them are a little sketchy. I mean, you always have the cycle types of analysis, your Elliott wave. There's a lot of Elliott wave practitioners that are calling for a top somewhere around the 1270 to 1290 range here. They're expecting the market to top out and a new wave lower to play out. There's a lot of guys that are on that, have that as their preferred count. There's some other analysis that says that Thursday is a big turn date, Wednesday evening's a full moon. I mean, you've got all kinds of weird things kind of lining up, and there are actually traders that do look at lunar cycles, believe it or not, as well as astrology. So there's guys that actually do that and have success doing that. I, for one, am not an astrologer, nor do I ever intend to be, but I'm not going to fault somebody else for the way that they view marketplaces. And there's no doubt that the moon has strange powers. There's no doubt about that. But I'm not going to base my market decisions on lunar cycles, at least not at this point. But all those things combined with some other interesting data that I want to share with members. Number one, we're coming into a major formation, as I said, on the S&P, where it looks like we're going to have a double top. But there's some other interesting analysis that I uncovered today. I looked around at some of the guys that I follow pretty regularly and found a chart that I'm going to show members here just shortly. Let me go ahead and pause this for a second. I'll pull up the chart. And here we go. I'm back at you here. This is a chart that came from Jason Haver, and I normally don't talk about other analysts, but this is a guy that I follow. He does some interesting things with some chart work. He also does some interesting Elliott wave analysis that I follow and look at. I mean, don't get me wrong. I'm not basing my decisions off of one guy's analysis, but I find that he's done a very nice job, and he finds some interesting charts and analysis. And what he's showing here, and this is a chart I had to show members, I couldn't help myself, and basically what you're looking at is the NASDAQ total volume divided by the New York Stock Exchange primary market total volume. So it's a volume divided by volume, and this black line back here is the S&P 500. And what he's showing you is basically this is the sell line right around 2.6, and in the recent history, every time that level has been surpassed, it's offered a sell signal. The only time that hasn't been the case is this period right here back in March of 2010. It issued a sell signal, and clearly you can see right here the market just continued to rally. But almost every other point corresponds with an intermediate top. So we look at right here, 2.67. We're right near the top of 2010 that we see in late April, right before the May flash crash. And obviously we see that 2.67 marked almost the top. Here's another point where price, this ratio went through the roof and crossed that sell signal line right at a major top. Big sell-off in the S&P. That was in last November of 2010. And then we saw it happen again in May of this year, which basically marked the market top. It crossed it again here, which represented another intermediate top. It crossed the line here at 2.74 right before we had our big sell-off in late June. And as we see today, we're at a record high. The highest point right now, this ratio is at the highest point it has been at in 3 years. And what that is saying is, in my estimation, and what Jason's trying to point out with this chart, is we are, and based on this analysis, very close to a top. And his Elliott wave analysis, he's expecting price to come into maybe the 1290 area, double top type formation, and then a major sell-off. That's what he's forecasting. I don't know whether or not that plays out, but it certainly holds sway based on this chart, and there's no arguing that this is an interesting indicator. And it is something that I will openly admit, it's something that I had not seen before. I've done a lot of volume types of analysis with different ratios, but this one is one I'm going to keep on the radar to use going forward. I think it's certainly interesting, and I think there's also a use for it for the in terms of trying to find good entry points as well. So from the long side, but I wanted to at least show this to members, and I think it's interesting to say the least. Another interesting thing I wanted to point out to members before I start talking about Europe, while we're looking at some underlying technicals, the index put-call ratio hit a level today that we have seen. It hasn't happened many times, but the put-call ratio is at a level where the last 5 times it's gotten to this point. The put-call ratio regarding index options, the last 5 times that's happened, in 4 of the past 5 times, within 1 week the market has sold off sharply, and in one case the sell-off was as high as 7%. So just another indicator to throw at you that is certainly arguing for potentially lower prices. We have a lot of indicators. We got the Elliott wave guys. We've got some other Elliott wave practitioners that are talking about the dollar, and that it is in a formation that it could really take off and rally. So we have a lot of people that generally disagree, all kind of coming together. Now, does that mean that the stock market has to sell off from here? Absolutely not. These are just things that I look at from a day-to-day basis and try to gauge on top of just looking at charts and some of the fundamentals that are out there. I also like to see what other experts are saying, and when they all it's very rare that they all agree, but every now and again you'll have a scenario where you have a lot of agreement among analysts that are all very, very good at what they do. And when that happens, I pay attention. And right now, yeah, I'm hearing that from a lot of people that I talk to, and other traders that I know personally. We're seeing a scenario where higher prices seem likely in the short run, but in the intermediate to long term, it's questionable. Another interesting area to point out is that equity from the retail side, if we look at retail investors and where they're putting their money, huge inflows recently based on data that's out there regarding mutual fund inflows, and the majority of the inflows are coming in the form of long-only equity mutual funds where they hold stocks long. There's no hedging, and they're certainly not short. So there's been a lot of money flowing into the retail crowd is putting a lot of money in stocks right now, and that also doesn't bode well for the market, because oftentimes the retail crowd gets in at the very end, right at the top, and then the market drops out beneath them. They're usually late to the party, and that's kind of where we're at now. We're seeing a lot of equity inflows from the retail crowd, so that's another concern. But my single largest concern is not some chart or some technical analysis or some Elliott Wave practitioner or where we're at in the lunar cycle. That to me is just noise, a lot of it. There's some good data points in there, but some of it is just pure noise. And what I'm looking at is the structural problem that we have in Europe, and why and to hopefully try to explain this a little bit better to members. I'm not trying to hold myself out as an expert here, but at least explain what's going on in terms that at least make some sense, and why Europe is such a big issue. As it stands right now, most people are focusing on Greece. And in my estimation, Greece isn't really that important. Greece clearly, has huge financial issues. Where they go, who really knows what's going to happen if they even stay in the euro? That, to me, Greece is irrelevant. And why do I say that? Just simply because of the size of the country, and their GDP levels are tiny when compared to the rest of the Eurozone. They represent a very small sliver of economic growth, so they're really not on my radar. What's on my radar is Italy. What matters so much more than Greece is Italy, and Spain isn't too far behind, but Italy, it finds itself in the crosshairs. And what we're seeing is all these prime ministers that are trying to push austerity measures through they're getting thrown to the wolves. They're getting booted out of office, and they're resigning, or they're under so much pressure they're forced to resign. Well, the reason Italy matters is because the size of Italy's debt. The estimate most of the estimates that I have come across from credible sources put the Italian debt somewhere in the 2.7 to 3.2 trillion dollars in their actual debt. And the other issue at hand in regards to that debt is the duration of their portfolio. The majority of the bonds that are coming due for Italy are all coming due in the short run. A lot of them are coming due in the next year. There's estimates that as many as over $200 billion worth of Italian debt will come due in 2012 alone. $200 billion that's going to be looking for new investors. And what's happening to yields in Italy on Italian debt? They're soaring, absolutely soaring. And they're getting to the point where Italy is going to be shut out of the private market, and they may be only able to raise money through the European Financial Stability Facility, EFSF, which might as well just be called European TARP. The problem is Italy's debt problem it's not like Greece. They have enough money to kind of backstop Greece. Italy's a whole different scenario. Italy has enough debt that the EFSF, what they're trying to lever up to, they can only cover 1/3 of the entire debt of Italy. On top of that, the IMF would have to come up with $2 trillion, which they don't have. And as it turns out, there's no money. Where's this capital going to come from? I mean, what the banks are already under pressure. They've got capital requirements. They have to raise capital. They're doing that by selling some of the debt at fire sale prices, because A, it reduces their risk of their portfolio, and B, it raises capital, and it helps them put them in good order from where they're supposed to be at within a year. But are the banks going to turn around and then buy that debt back? I don't think so. And the last time EFSF tried to sell, I think it was $3 billion of Irish debt about a week ago, they couldn't, even with a AAA rating from the EFSF, they couldn't get private investors to come in and buy it. That's the problem with these debt markets. At some point, it will matter in the United States. You can't put a gun to people's head and make them buy it. And when they don't buy it and the auction fails, you don't have the money to operate your government. That is as plain and simple as it is. And Italy is going to be looking at trying to raise over $200 billion in 2012 of new money, because their bonds are going to mature. And on top of that, the interest rates that they're going to be paying are so high, it's not feasible. They cannot survive based on where they're at. Austerity measures or not, it doesn't matter. At interest rates of this level, at this magnitude, they can't service their debt 6 months from now. Not without raising taxes through the roof and pushing austerity measures, which the French people aren't going to like. And you're going to have rioting, and then Sarkozy is going to come under pressure. It just doesn't end. Or excuse me, I'm talking about the French. In Italy, Berlusconi has already been booted, and then if you get into the situation where Italy isn't able to pay their debts, Berlusconi's already out. The guy that they're talking about that's going to potentially replace him is extremely liberal. And the last time the liberals were in, back in like 1994, in the early 90s, they actually went into people's bank accounts and took lira out to cover some of the expenses of the government. And they're going to, you talk about tax the rich in the United States, Italy is known for that. They're going to go after the rich people. They're already fleeing, and they're already taking their money out of Italian bonds, and the rich are going to do everything they can to shield their money. Why do you think gold, silver, and oil are rallying? They're putting money in assets that in their currency, if the euro blows up, they are hedged. And on top of that, that money is invested into safer areas. Compared to the euro, gold is a much safer long-term bet than the euro, particularly with what we're seeing in the structural underlying debt instruments of this region. And we haven't even got into the discussion. So we haven't even got to the discussion of what's really scary. Fact of the matter is, Italy is a huge problem, and the spreads are widening every day. So at this point in time, we're at a point where Italy is on the precipice of not being shut out of the private market, because they're not going to be able to afford the rates. They have too much money coming due, and they're going to, first of all, can they even get enough investment to cover what they need, assuming that they can from the EFSF and the Eurozone, which I think will happen. I think they get the money at a decent rate. The problem is what happens to all the rest of their bonds that are further out in time. Those bonds don't go away. So it doesn't change their debt structure. They might be able to, the EFSF might be able to cut them a deal on the interest rate, but they still are going to basically be forced. 1/5 of the entire EFSF fund will be required in 2012 just to cover Italy, assuming that Italy's debt, assuming Italy itself has no other option and isn't able to pay those debts down. So where are we at right now? Now let's talk about the real problem with Italy. And I just took a quick pause to take grab a drink, and then also to refresh the exact numbers, make sure my numbers I'm about to say are accurate. Well, when we look at Italian bonds, we compare them to the spread against the German 10-year bond. Or they prefer to call it the Bund, B-U-N-D, but it's a 10-year Italian debt versus the German Italian debt. And at 500 basis points, and that's fancy term for 5%, when that level gets to 5%, when the differential between the spread is 5% for an Italian 10-year versus a German 10-year, and in the 5% I'm talking about is the difference in the interest rate. So if the German Bund's paying 1.8, the Italian debt is paying 6.8. 6.8 minus 1.8 is 5. There's your 5%. 500 basis points. Okay. The problem is that around 500 basis points, margin calls based on collateral on the underlying Italian debt are likely to begin. And I'll talk about margin calls in a minute. At 500 basis points, that's kind of the line in the sand. We closed today at the close 4.97. That is the spread between the Italian 10-year and the German 10-year. 4.97, around 5 margin calls begin. So where do margin calls come into play? Margin calls are critical because all of these banks that hold all this debt, these European bonds, and some of them are European banks, we have American banks, all these different banks that hold them, they hold them in leveraged portfolios where they have collateral that they've leveraged up to buy more debt back when they thought these were good investments. The problem is at 500 basis points, the value of the bonds has dropped sufficiently that they're required to post more capital to maintain their position because of the leverage. They have so much leverage that after a certain move in the differential on that spread, basically they're forced to raise their capital in that portfolio in order to square their positions up in terms of their maintenance and the collateral required to maintain the leverage. So what does that mean? We're talking about the potential for 15% margin calls on portfolios that could be in the tens, if not hundreds of billions of dollars. So let's say I'm a bank, I've got $50 billion of Italian debt, and that may be a small number. There may be Italian banks that have 3 or 4 times that number. But let's just say I've got 50 billion. I get hit with my margin call of 15%. I got to come up with $7.5 billion to maintain my portfolio. And that doesn't mean that if prices, that everything's okay. If prices continue to go down, I have to come up with even more capital as a bank or a financial institution. Hopefully that's starting to trigger some thoughts in some of your minds. All of a sudden margin calls go out. Now capital is going to have to come out of these banks which are already trying to hoard capital based on these requirements from the Eurozone. And now they're going to have to take capital and inject that into those portfolios to maintain the margin, to maintain the current portfolio and to cover their margin call. Otherwise, it's a forced liquidation. Keyword being forced, meaning the broker-dealer or whoever's holding those bonds or who's holding the collateral on the other side of those bonds, they force the sale of those bonds and they don't care what price they get. They want their collateral back. So what turns out happening is we have a scenario that's potentially unfolding that smells, tastes, and looks just like 2008. That's what caused all the exacerbation in the sell-off was primarily margin calls on all these different debt instruments, specifically mortgage-backed securities in 2008. 2007, when the margin call started, there was nowhere to hide. The selling kicked in, and all of a sudden you had forced liquidations and redemptions and massive capital write-downs, and all of a sudden these banks are running out of capital. Now they're forced to sell things they don't want to sell. All of a sudden they're being forced to sell their stock positions and their gold position and all these different positions, and everything just gets killed. I'm not saying that's going to happen in Europe, but I'm not going to say that it isn't, because this margin call situation is a huge problem. And if that margin call situation begins and that snowball begins to roll down that mountain, it could cause an entire financial collapse. I'm not talking about we're going to be living, squatting in our homes and having fires to stay warm. I'm not talking about that. I'm just talking about a financial market blow-up where we have a fat tail black swan risk, where we have a huge blow-up. I'm not trying to say that this is going to happen. I don't know that it's going to happen. But the writing is on the wall. We can't ignore what we're seeing. And the market is going to do everything it can to shrug that news off, just like it did in 2007, just like it did when Bernanke came out and said the subprime mortgage mess was contained. He said that, and 6 months later, it was imploding on itself. These politicians don't know what's the truth of what's going on behind the scenes. The only people that really know are the banks, and they're scared to death. And as it turns out, on top of that, we're not even getting into the notional derivatives that are interlinking all of these debt instruments, some of which are backed by collateral, which is essentially worthless. There's certain pieces of collateral that some of these CDS swaps were backed by, which are debt they're backed by European debt. So you have collateral that's backing these credit default swaps in some cases that hasn't been marked to market, and the fact is, if there was a collapse, the counterparty risk, these entities don't have the capital to cover some of the risk. And on top of that, all these banks are on both sides. For example, Goldman Sachs wrote credit default swaps on Italy's debt that J.P. Morgan bought, and then J.P. Morgan sold credit default swaps to AIG on Italian debt, and it just goes on and on and on, and it's all interconnected. Somebody has to lose. They're not all going to win. And all the talk at the investment bank level with the recent Jeffries discussion has been about gross versus net. Gross exposure is the total exposure and the total ownership they have of any specific underlying asset. Net is after the hedging and the shorts and their actual net exposure. The problem with net is that it assumes that the credit default swaps are going to protect the downside and that their short positions are collateralized properly. If they're not, those short positions aren't worth anything. And just like what happened in 2008 and 2009 in the United States, all of a sudden, whoever's on the other side of those credit default swaps, they get a phone call saying, hey, these CDS swaps just got triggered. You owe us $250 billion, and we need it tomorrow. That could happen. And then all of a sudden, they're scrambling to try to find where they're going to get their assets to cover the margin call that they owe on their CDS swap. It just turns into a nightmare. I hope this is starting to make sense to some members that may not understand. What we're looking at, the credit markets are far more important than the equity markets ever are. The credit markets are much larger, much more money, and when the credit markets start to deteriorate, it's impossible for equities to hold out for very long. Look what happened in 2007 through 2009. The credit markets started to collapse and stocks got abused. Just flat out taken to the woodshed and abused. So we're sitting here, and on top of all of that, how does that impact the United States? Well, clearly it impacts our banks to some degree. But what do you think happens when an Italian bond is sold? What does that do to the euro currency? Well, technically, it's a sale of a euro-denominated asset. So where do those euros go? What does that do to the exchange rate? All of a sudden, the dollar starts to get strong, and now we have a strong, raging dollar that's surging higher exponentially, that goes parabolic. What would that do to our market construct? It kills us. It kills risk assets. Stocks sell off. The only thing that might hold up well in that environment is gold and silver. Oil gets killed. Copper gets killed. I mean, there's nowhere to hide. The only place you can hide is the dollar, treasuries, municipal bonds, and maybe gold and silver, and that's just about it. I'm not trying to be Chicken Little here and say the sky is falling. I am telling it like it is. You can research this information. It is out there. This isn't some kind of conspiracy theory. I don't know what's going to happen, how this is going to play out, and I'm not going to suggest that it's not going to end, that it's going to end poorly. You never know. Cooler heads might prevail. Some smart people might figure out a solution for Europe, and everything goes hunky-dory. But the flip side of this ride is simple. It ends bad, and when it ends, we're talking about a cataclysmic sell-off. And you know what? I want to be there to buy. If I'm wrong, I'm fine with that. I'll continue to trade the market I have, not the market I expect. But if we get into a nasty situation like that, I'm not even worried about making money for members on the downside, and I know that's not what you want to hear. I want to be there to buy when I want to buy into a market where it's stupid to buy. Just like it was dumb to buy in March of 2009. It looked like you were insane. You were playing chicken with a train. But that wasn't the case. And that's the thing I can tell you. I will, if we get into that scenario and we're just getting killed, if that plays out, there will be a point in time where I get long stocks for a super long term and I shut my eyes and I look it around and say, this is the dumbest thing I could do, and that's why I'm going to do it. Because sometimes if this situation plays out, we're talking about opportunities across the board that are going to be generational lows if it plays out. I'm not saying it's going to happen. I am not. I want members to be clear. I am not calling for a market collapse. I am not calling for the end of the world as we know it. I am simply stating facts based on where we're at in the European situation with their debt and all of the different notional derivatives and how this whole the margin calls, how it all plays together. Hopefully now some of you have a little bit better understanding of the situation and the severity of it. And keep in mind, it takes time for these things to come to fruition in the market. The market will get spooked if things don't go a specific way in those credit markets, and they're on the verge of being spooked now. Just as prices are rallying to highs on the recent highs on the S&P 500, we have diamond patterns showing up all over the technical saying we're at an inflection point. We have a head and shoulders top formation showing up on the daily and hourly chart of the S&P 500. And on top of that, the put call ratio is at a level we haven't seen it at in quite some time. 4 out of the last 5 times we've had a major sell-off. And on top of that, the ratio between the total volume on the NASDAQ versus the total volume on the NYSE is at an all-time high over the past 3 years. We have evidence that says things are going to happen. The question is the market shrug this thing off? And we have, the hedge funds and the mutual funds chasing performance into year end. That could happen, and we could see prices rally like crazy. But at the end of the day, if they don't get this situation squared away in Europe, and I'm talking they have weeks, maybe days, with the Italian debt, because it's on the verge of causing margin calls. And once the margin calls start, that's when things are going to get real ugly, because now you're going to have forced liquidations of Italian debt, which is going to cause even more sellers to come in and begin selling Italian debt, which is going to push yields even higher and put even more capital pressure on the Italian government and the financial construct of Italy as a country. It puts everything into context. This whole scenario is very concerning. So I'm going to go ahead and jump off my soapbox. I think that should be a rant that covers us for at least another 3 or 4 weeks before I have to rant again about something else. But feel free to send me some emails, some comments on it. I think I try to do a decent job of explaining my position, as well as some facts that are based on current economic data coming out of Italy. I think Italy is what I'm very much more concerned about. Greece isn't even on my radar at this point. Italy is the problem. Italy is where we have to keep an eye, and I will continue to follow this as time goes on. So with that said, I'm going to go ahead and sign off this evening. I hope everyone had a safe and enjoyable day today. I know we haven't had a lot of activity for the service, but I just feel like we're at a point we could go either way, and I do not want to put too much capital risk out there. I do believe that the dollar is going to rally, and I personally think in the short run we could see the stocks push a little bit higher, but I do think we're getting close to a top there as well. And I don't want to push things. I don't want to get on the wrong side of the market at a major inflection point. I can't. All the analysis I have says we're at a very important inflection point, and I'm not going to be on the wrong side of this market. I'm just not going to do it. And if that means we sit and twiddle our thumbs for a little bit, then that's what it means. Let's let everybody else be the hero, and let's come in and take trades when the probability is in our favor, risk is relatively low, and we can take advantage of some time decay type trades in an environment where volatility doesn't chew us up, and we're not having huge price swings intraday and underlying indices that we're seeing today. So with that being said, I'm going to go ahead and sign off. Take care. Have a great evening. I'll be in touch tomorrow morning with additional analysis. Take care. Good night.